Welcome to ICAN Intelligence. Look, if you're gearing up for your exams, you already know that just memorizing rules won't cut it. To really succeed, you need to understand the concepts. That's what we do here. Today, we are going to build a complete and lasting understanding of a standard that trips a lot of people up. IAS 29, Financial Reporting in Hyperinflationary Economies. Let's get into it. All right, here's our game plan. First, we have to understand the problem. Why does hyperinflation completely wreck normal accounting? Then, we'll look at the one single elegant principle that IAS 29 uses to solve it. After that, we'll get practical. We'll actually apply this principle to the financial statements, cover the disclosures you have to know, and finish up with a laser focus on what the examiners are really looking for. Every single accounting standard was created to solve a specific problem. So before we look at any rules or calculations, we have to start with the why. What is it about hyperinflation that is so dangerous to financial reporting that it requires its very own standard? The standard itself basically tells you right in the opening paragraph. Think about it like this. A company makes $100 million in revenue one year. A couple of years later, it makes $200 million. On paper, that looks like incredible growth, right? But what if in that time the currency has lost, say, 75% of its value? That growth is a total illusion. The numbers aren't just unhelpful, they are actively misleading. You can't make a sensible decision with them. Okay, so what's the magic number? When does regular inflation become hyperinflation? Well, here's the crucial point. IAS 29 does not give you one. There isn't a fixed percentage that triggers the standard. Instead, it's all about professional judgment, about looking at the economic environment for certain telltale signs. And these, right here, are those signs from paragraph 3. Now, this is a classic exam theory question, so you'll want to know these. We're looking for clues, like when the general public would rather hold, say, a building or US dollars than the local currency, or when prices for things are quoted in a more stable foreign currency. And while it's not a hard rule, the standard gives us a quantitative guide. If cumulative inflation over 3 years is getting close to or goes over 100%, you're probably in hyperinflation territory. Okay, so we've got the problem. The very unit we use to measure everything, money, is broken. It's like trying to measure a room with a ruler that keeps shrinking. So what's the solution? Well, IAS 29 is built on one core, simple principle that fixes this, and every single calculation we're about to do flows from this one idea. And here it is. This is the whole standard in a nutshell. We take all the old numbers and restate them into the measuring unit that's current at the end of the reporting period. Basically, we're taking transactions recorded in old, weak money and translating them into today's money. This gives us a stable yardstick so we can finally compare apples to apples. We're not rewriting history, we're just restating it in a language that makes sense today. Pay close attention here because this slide is the absolute key to everything. If you can get this distinction right, you have mastered half of IAS 29. It's where the exam marks are won or lost. Monetary items like cash in the bank or a loan are fixed. A $100 debt is always a $100 debt. It's already expressed in today's money, so you do not restate it. A common mistake is to restate cash. That's fundamentally wrong. But non-monetary items, like a machine you bought 5 years ago, are stuck in the past. Their cost is recorded in old money. They must be restated to today's values. Okay, enough theory. Let's get practical. How do we actually apply this principle to the statement of financial position? We're going to walk through the mechanics, line by line. This 5-step process is your engine for any IAS 29 question. First, you find the asset's original cost. Then you inflate that cost using something called a general price index, or GPI. It's just an official index that tracks average price changes. The formula in step 4 is your best friend. Historical cost times closing index divided by opening index. And please do not forget step 5. This is a crucial link to other standards. IAS 29 doesn't live in a vacuum. After you restate the asset, you still have to check if it's impaired under IAS 36. Now, let's talk about equity. This is another spot where examiners test your precision. Share capital? You restate that from the date the money actually came in. Any old revaluation surplus? It gets eliminated. But here's the most important part, a huge exam technique point. You never try to restate retained earnings directly. It's the balancing figure, the plug. You restate everything else, all the assets, all the liabilities, the share capital, and whatever number you need to make the accounts balance, that's your restated retained earnings. Okay. The statement of financial position is now stated in current terms. So let's take that exact same core principle
and apply it to the statement of comprehensive income. You'll see the logic is exactly the same. Just think about it. A business makes sales and incurs costs every single day of the year. Are you going to restate 365 individual days of transactions? No way, that's impossible. So in practice, and definitely for your exam, we take a shortcut. We use an average GPI for the period to restate all the income statement items. It's a practical way to get them all expressed in the measuring unit at the year end.
Now this is one of the most unique and interesting parts of IAS 29. It's the gain or loss on net monetary position. It happens precisely because we don't restate monetary items. Let's make it real. If you are holding a ton of cash, a monetary asset, and inflation is roaring, the value, the purchasing power of that cash is dropping every single day. You've lost purchasing power. But flip it around. If you have a huge bank loan, a monetary liability, you've kind of won. The real value of your debt is shrinking. You get to pay it back with cheaper money. That's a gain, and it goes straight into your income statement. So this calculation might look a little intimidating, but it's actually just a reconciliation. You're basically asking, what should my closing cash and loans be if they had perfectly kept up with inflation? You calculate that expected number. Then you compare it to what your actual closing balances really are. The difference between the should-be number and the actual number is your gain or loss from purchasing power. It's the gap that inflation created.
Look, getting the numbers right is only half the battle. If you don't tell the users of the financial statements what you've done, the numbers are meaningless. Disclosures are absolutely vital for providing context and, let's be honest, for picking up some very easy marks in your exam. Paragraph 39 gives us 4 disclosures you just have to know. These are free marks, so don't leave them on the table. You simply have to state the obvious, that you've applied IAS 29. You have to say which price index you used. Was it the official consumer price index or something else? And finally, you have to state what the index number was at the end of the year and how much it changed. That's it. It gives the reader the full picture. Okay, we have covered a lot of ground. We've done the why, the what, and the how. Now let's pull all of this together into one coherent framework so you can walk into that exam hall and explain the standard with total confidence. This right here, this is the entire standard in a single flow. It starts with the problem. Your data is misleading. You apply the principle. Restate everything to today's money. The procedure to do that all hinges on separating monetary from non-monetary items. And the result? Financial statements that are comparable and actually useful again. If you can explain this chain of logic, you don't just know IAS 29, you understand it. And I'll leave you with this final thought. This is the kind of higher-level question that can really set you apart. It's not just about applying rules. It's about connecting what you're doing back to the big picture, the conceptual framework. So think about it. How does adjusting for purchasing power help the financial statements achieve faithful representation? How does it give a truer picture of a company's performance than just leaving misleading historical numbers in there?
And that's our deep dive into IAS 29. I really hope this helped to make the standard click for you. If it did, please do me a favor and hit that like button and subscribe to the channel. And more importantly, drop a comment below and let us know which accounting standard you want us to tackle next. Thanks for joining me.